Bank of America recently upgraded their price target for Nvidia stock up to $190 per share. That's how much they think Nvidia stock is worth today, the intrinsic value. Now, I'm going to share with you the video of the analyst Vivek Arya that is making that recommendation upgrade on Nvidia stock and his reasoning why he believes Nvidia stock is undervalued. And then I'm going to share with you my opinions, my analysis on why I agree with this one point that he's making about Nvidia stock and its comparison on the valuation and why he feels it's still undervalued. So let's take a look. This is an interesting analysis here coming from Bank of America. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Is that the opportunity is much larger, their competitive position is much stronger. And then finally, when I look at the stock, right, we have a stock that is trading less than 1 times earnings growth. And if you were to take an average of the other so-called Max 7, they are trading at 1.9 times their average earnings growth for next year. That is why we think that we are in front of a large opportunity. The company is executing well, and the valuation is very compelling, even at these levels.
All right. So the analyst here stating that they feel Nvidia is undervalued, and especially when you compare it with their other Mag 7 partners, they look very undervalued and attractive. So let me share with you what this analyst is talking about when comparing with the other Mag 7 companies or other large cap tech stocks, right? And so I have a list of large cap tech stocks here, including Nvidia, Apple, Microsoft, Tesla, Amazon, Alphabet, and Meta platforms. And you can see their valuations here on a forward PE basis. Nvidia is trading at a forward PE of 34, Apple at 27, Microsoft at 28, Tesla incredibly overvalued at 67, Amazon at 32, Alphabet undervalued at 19, and Meta platforms at 23. So you see Nvidia here about in the middle of this, trading right about the same valuation as Amazon, Apple, and Microsoft, and about half of the valuation of Tesla. And so what does this analyst mean by the forward price to earnings ratio or the price to earnings ratio compared to the growth rates? Well, to see that, we want to look at the company's long-term growth expectations, right? So according to the analysts on Wall Street that are following these companies I highlighted, Nvidia is expected to grow at a faster rate in earnings per share compared to all of the others. You can see here Nvidia's earnings per share long-term growth estimates at 38.2%, Apple at just 9.43%, the worst of the large cap expectations, Microsoft at 13%, Tesla at only 12.4%, Amazon at 22%, Alphabet at 17%, and Meta at 23%. So at 38%, Nvidia is expected to grow at much faster than the other companies. In fact, more than double the rates of growth of Alphabet, Tesla, and Microsoft and Apple. And so it's trading at a valuation that's at 34, but when you compare with the long-term growth rate of 38, it's less than 1 times its long-term growth of earnings per share estimate. That's what the analyst means by comparing what you're getting in terms of earnings per share growth versus the forward PE multiple. And it's the best rated comparatively using this comparison with these other Mag 7 companies. Now, if you look at Apple, it's trading at a forward PE of 27, and its EPS expectations growth-wise are just 9%. So it's trading at 3x its growth expectations. That's roughly 3 times the valuation of Nvidia when comparing it in this way. And then you look at the next one on the list, Microsoft, forward PE of 28, earnings per share expectations of just 13, so more than 2x the expectations value. And then the next one, Tesla, trading at a forward PE of 67.6, with its earnings per share expectations only 12%. So Tesla is at more than 5x multiple of its EPS growth over the next 5 years. And yet another data point that justifies why I've been saying how much Tesla stock is overvalued. This is yet another data point. And if you've been watching my videos, nearly every data point I look at suggests that Tesla stock is overvalued. The next one, you can see Amazon forward PE of 32, growth rate expectations of 22. Not that bad, right? Trading at about a 1.5 EPS estimate. And then Alphabet forward PE of about 19, growth rate of about 17, so about 1-to-1 here with Alphabet. And finally, Meta Platforms forward PE of 23 and EPS estimates of 23, so about a 1-to-1 valuation. So regardless of which one you look at, Meta is the next one that's most attractive according to this one valuation comparison estimate. Nvidia is much better than all of them, right? At a forward PE of 34 with EPS long-term growth rate estimates of 38. And let me elaborate on why this is important, on why this metric, on why this comparison is important. When you're buying a stock, you're buying a percentage ownership of the business. And when you own a business, you are entitled to that business's revenues, profits, and cash flow. So what you'd like to see from a business that you own is that profits increase and cash flow increase. And with Nvidia, you're getting 38% expected long-term earnings per share growth. This is between 5 to 10-year outlook here. And so if you're buying Nvidia with expecting this year's earnings, let's say, to be $100, next year, the earnings will be $138. The year after that, earnings will be closer to $180. The year after that, earnings will be closer to $225. So just in a couple of years, your profits from that company have more than doubled when you're growing at this rate. So what you'd like to pay is a valuation that when you compare with the expected earnings you're going to get over the next few years, looks attractive. And that's what you're getting with Nvidia. You're getting a valuation today that when you incorporate the earnings per share expectations over the next 5, 7, and 10-year periods, looks very attractive because the company's earnings per share estimates expectations are so robust. And the reason why its earnings per share estimates are so robust is because the products that it's offering are experiencing significant growth. The next generation Blackwell technology, their CEO said it's sold out. So for the next year, their product is sold out. Their most popular product is going to be sold out. And then the year after that, they've already got the Rubin technology announced. And the overall industry that it's selling into is expected to grow by over $1 trillion over the next decade. Nvidia captures a large market share in that massively, quickly growing artificial intelligence market. So for this reason, and in this one data point, I agree with the Bank of America analyst in the comparison here and suggesting how undervalued Nvidia stock is, especially when you use this one comparison. Now, there's several valuation methods you can use, and for the most part, nearly every valuation estimate I've used with Nvidia stock has pointed to the company being undervalued. And I have dozens and dozens of videos on Nvidia stock on my channel, and you can go through all of them and see all my different valuation estimates using different valuation tools. And I've come to the same conclusion with Nvidia, similar and the opposite to Tesla. Nearly every valuation estimate I use with Tesla shows me that the stock is overvalued, and it's the opposite with Nvidia. Nearly every valuation estimate I use with Nvidia shows me that Nvidia stock is undervalued. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.